Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in digital technologies, emerging technologies, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Joyce, Managing Director on the Nasdaq Market Intelligence Desk, Michael Normyle, U.S. Economist at Nasdaq, as well as Joe Cavatoni. He is Chief Market Strategist at the World Gold Council. I've only had you on since the inception of the show. We're here to discuss developments in the gold market and the impact to the macroeconomic environment. And Joe, I'm going to twist this around in my favor, but as we're sitting here getting a headline, Trump saying framework of a future deal with NATO on Greenland agreed and drops tariffs threat. And we can see the reaction that's happening in the markets. And I think that's really been the story despite the longer term trajectory of any asset class.
So I'm going to cut you a break on getting my title confused for you there, because simply put, the chaos, the noise, the headlines, everything that's happened just since January 1 continues to put on the horizon risk and uncertainty, volatility, and actually looking at an asset like gold, it's ripe for people to understand how it can fit in their portfolio. You know, we were up about 11.5% before the news that we've just heard it broke about a moment ago. Let's see where we continue to go. But one thing for certain, risk, uncertainty, disruptive policy behaviors on the horizon for the year, and that's going to be a tailwind for the gold market.
Yeah, and Michael, from your perspective, as an economist, do these types of moments change your outlook from a longer term perspective?
I suppose not really. I think, we have to expect the unexpected a little bit, and that's certainly been the theme to start this year. So I think a lot of that is baked in to an extent, and then we've kind of learned that there can be periods where we see a lot of noise and not a lot of the end result is kind of a smaller or non-story ultimately. Of course, we're still in the early stages here. Who knows what the next headline is going to be, right? So that could change. Yeah,
and I mean, of course, you're focused on broader themes such as what's happening in the labor market, inflation, and so forth, because many of the 2026 outlook pieces I have read were, kind of looking for somewhat of a relatively stable policy environment as almost a catalyst, because we saw that volatility last year and kind of understanding the direction that the Fed might take monetary policy in. So it could change at any time, but again, you're looking at different parts of the equation as well.
Yeah, I think the big things we've been looking at this year have been lower interest rates around the world, whether that's rates that were cut last year or additional cuts coming this year, depending on which central bank you're looking at, but that feeding through into major economies around the world, as well as we've got a lot of fiscal stimulus around the world. In the US, of course, the One Big Beautiful Bill Act tax cuts are kicking in. That's going to help consumers, that's going to help businesses. In Europe, you have increased defense spending. In Japan, you have your own stimulus package. And then, of course, continued AI spending, right, with CapEx plans for those AI hyperscalers expected to increase about 25% from where they were last year, which was already a 50% increase from the year before. And so that's been an actual impact on GDP like we saw last year, where close to half of GDP was, through Q3 at least, we don't have Q4 data yet, but close to half of it was that AI investment component, right? So I don't think it's going to be as big of a share this year. I think hopefully we get a bit of a broadening of the base for the economy this year. But those were the themes that we were really focused on.
And Brian, of course, from a trading perspective and the technicals that you're watching and what's happening in the gold space, give us some.
I mean, the breakout, the uptrend really, to me, started in October of 2023. And a month or so later, really by March 24, we were breaking out, to new all-time highs, and it's hardly looked back. So we've had very little pullbacks along the way. This year already, year to date, gold, is continuing to march higher. So a resolution in Greenland, could certainly, cause some short-term, pullback or a pause, as Joe was saying earlier off air. But it just looks phenomenal from an investment point of view, and there's plenty of reasons why you can think fundamentally it deserves a place in a portfolio. Particularly if the 60-40 portfolio has been questioned ever since 2022, given the rise in interest rates and the fall in bond prices. Gold that year was basically flat. I think in the 15 worst quarters for the S&P 500 going back 15 years, gold was higher in 12 of those 15 quarters. So it's a very good non-correlated asset, or negatively correlated, as Joe was saying, during times when equities are trading down.
Yeah, well, but it really hasn't been. the correlation isn't as obvious, let's call it, over the past couple of years.
Well, I think it's been hard to kind of call risk assets in an environment that's so volatile. And I think what is very interesting about what, Michael, what you were saying is that underpinning all of this are still a lot of economic conditions that we're really having a hard time judging and reading. And the monetary policy guesswork that we're all living in is actually making it even more complex. Are we going to see cuts? Do we need cuts? Is the data reliable? Is the shutdown in the government caused us to have a hiccup with this? Is this systemic from a fallout of COVID? It's hard for anyone to gauge and really understand. So I think the risk and uncertainty of markets generally around the world, a question over the role that the dollar and dollar-based assets might continue to play in a world that's rapidly developing into a China-US duopoly. Like, people are starting to diversify globally, keeping gold bid up around the world, but maybe now only as people are starting to see risk assets under pressure in the US and Western markets moving into it. So you've been seeing record flows in ETFs, 7 months of consecutive flows there. We're about to release our fourth quarter and full year GDT report. Don't be surprised if we show you some record flows that are surfacing there. Maybe not central banks, but maybe in investments in other parts of the market. You might be surprised around what you hear about jewelry, the consumer side. When people are having a few more dollars in their hands, in their pockets, they might be spending more.
So you think when we get tax returns because of OBBBA SALT, which we finally got back in this area, you think that you're going to see increased spending on the consumer side as a result of that?
I think I look at it specifically around the gold market, and I think what you can definitely see is a world where a gold market could benefit from people having money in their hand, whether it's to save and spend or to just simply save. And I think that that's actually a key component. You got to look at this gold market beyond ETFs, look at the physical market, look at the jewelry market, and keep in mind this is a global phenomenon for gold. We've seen Eastern ETFs, the Eastern markets, China, India, Japan, record flows in ETFs, you know, an abundance of different ways for people to own gold in those markets, and the central banks continuing to be at the table. And now it's really becoming a Western market phenomenon.
Yeah.
And people are asking the right questions. What kind of diversification? How are my bonds going to perform? What should I be expecting from risk? And these uncertain moments that just keep popping up.
Yeah. And Michael, we were talking off camera about it, why we're not seeing yield here. What do you think are some of the reasons behind that?
I mean, it's hard to say what investors are thinking en masse, right? But you know, it could just get back to what I was saying earlier, where people are kind of in a wait and see mode. What is this going to amount to? You've heard Danish pension funds saying that they're going to sell U.S. Treasuries or have sold U.S. Treasuries, but it was on the order of $100 million, which is a drop in the bucket when it comes to the Treasury market. So unless there's kind of a bigger move there, that's not really going to be pushing things too much.
Yeah. How do you think the lower dollar is going to impact earnings, which, you know, Brian, I'm asking you, like, I know it's a little bit early-ish, to tell.
I guess more impactful for the the more global companies,
Right.
the international companies, which would be I would assume a tailwind for them. Make their exports cheaper. We had a very strong decline in the first half of 2024. It was one of the worst declines for the dollar in 50 years in the first half, and we've kind of been in a sideways consolidation ever since. So I'm actually very curious to see if it's going to break down below what's been support over the last 6 to 7 months. And I think maybe what be holding yields down potentially could be what's going on in housing. I think wages are not as rising as they were in the prior cycle, rising as much, and so those might be some headwinds to holding rates down and not spiking as higher as we've seen in other countries around.
Well, I mean, that's a good point that you bring up. It's, to go a little bit off topic here, when we think about the housing market, I mean, the rates have really not fallen to a point where the affordability picture is going to change.
Yeah, but home prices have been coming down in the South and in the Southwest, and so if that were to continue, then that would be positive as far as inflation metrics go. Michael can comment on that better than I can. So I mean, where I live on Long Island, I go food shopping, and certainly inflation to me seems like it's a problem. But
I think regions of the South, though, it's idiosyncratic, right? Just because of the influx of people that move there, and then the concentration of private equity that has bought in those certain regions. But Michael, we were talking about this last week. Or the week before, there are some things such as insurance and taxes that interest rate cuts are not going to impact.
Right. Yeah. I mean, affordability is a tough nut to crack. Really, we've seen some efforts from the Trump administration. We'll see where they go, because some of those are going to need cooperation beyond just an executive order or things like that, with capping credit card rates at 10% or having Fannie Mae and Freddie Mac buy $200 billion worth of mortgage bonds. But there was a study I saw recently that was looking at what it takes to get housing affordability back to 2019 levels. And if you're looking at keeping incomes the same, keeping home prices the same, and moving rates, you need rates down to 2.65%. So that's not going to happen unless we go back to 0% Fed funds rate. If you keep the income the same and the rates the same, you need home values to fall 35%. And that's going to be a big problem for people that own homes. So it's a real challenge where you want homes to be affordable for younger people to get on the home ownership ladder, and then you don't want wealth destruction for people that own a home. So it's really a long-term issue where you need incomes to be rising faster than homes are rising, and maybe a little help from rates coming down.
And that central bank, this is where I'm tying this all together here, that balance is challenging. Speaking of central banks, so you did a podcast to kick off the year around digitization of gold.
Absolutely.
What do you think that could mean for the market and how it's accessible?
I think the market is absolutely ripe right now in the gold space, in the commodity space, to watch what we're doing around gold. So we're taking an approach that's different to many others. Most people are thinking about access points and tokenizing commodities or gold. And that's very helpful and interesting, but what really needs to change is the work we're doing around the infrastructure in the gold market. Because right now, if you own bars, if you own physical gold, there's not a lot you can do with it. That's why most people think about it as this asset that just sits on your shelf and you can't get a yield off of it. The work we're doing is to move forward on the wholesale basis to introduce gold into the collateral pools, using the different bullion banks and the vaults to actually unleash the gold, earn yield, actually improve lending, improve access to liquidity, bring more banks to the table to actually trade and give access points. That's the big piece that needs to move in the right direction. It's moving there. And with this technology we're talking about, a pooled gold interest, that's going to bring us to a world where most gold could then be lent more, financed more, and unleash it. In India, there's a huge market for lending against people's golds that they hold. This is why when we talk about consuming gold in markets in the emerging markets, they can deposit it with a bank and get a loan off the back of it. That doesn't exist in Western markets, and we need that in large scale. That's what we're going to do. Then plugging in digitization and access points to that wholesale market improvement becomes much easier, and you can have many people offering many different points. And the atomic settlement that could come along with what we're doing could then complement access points on the digital side.
Is it reliant on getting market structure legislation passed?
100%.
That's the whole thing. And part of the developments that we saw last week was around yields and what that's going to look like, and how that ethos is changing, where there was the decentralized nature of it. It sounds, the language in it sounds like it's becoming very centralized in terms of compliance requirements and what it's going to be regulated, or just the way the language sounded with the revision.
Just a few things to say on it. Number one, we are in regular and ongoing dialogue in the US, watching legislation here and around the world, UK, Europe, etc. Just keeping a pulse on what's happening around stable coins, other legislation that could be impactful to the commodity space. And where relevant, we're stepping in and helping them guide that legislation. But more specific to our initiative, right now we're in direct dialogue with the LBMA, working with them, other organizations, and the UK government and authorities to simply say, hey, look, we have a solution for an asset that needs to be really brought forward in the ecosystem, and there's support for us to get this done. So it's actually a great project. It's got a lot of potential. It's not quick, it's not easy, but it's the right kind of move in the digitization space to really change and transform gold, and then it could be applied to other assets and commodities down the line.
And Brian, we've seen the volatility within the digital asset space. That's no surprise. I mean, clearly having a reaction off of this type of news as well.
In the gold market?
We could talk about gold as well as what we're seeing with digital assets, Bitcoin as an example, and how it's reacting to these types of measures.
Yeah, I mean, the digitalization of real world assets, it's here. It's not just something that we've been talking about, but it's now here. And, to hear it now, Joe speak about how it's now, going to evolve in towards gold and precious metals, to me, it's exciting because the gold market and the precious metals and industrial metals, critical minerals, they've been just moving in price, and the momentum has been so strong. And to see that some of maybe what has been, difficulties with precious metals because their size, their weight, silver especially, to see that you can maybe using digitalization and tokenization and modern rails to improve efficiency and collateralization, that's all exciting stuff coming down the pipeline that Joe's talking about.
All right, appreciate all of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.